Over the last couple of weeks, markets have turned into a complete panic mode, and I think it is important in all periods of volatility to take a step back and understand what is justifiable and what is an overreaction. By and large, we think that the markets have severely overreacted. We are approaching levels in some of the emerging market currencies that we have not seen since the mid or late 1990s, when conditions were far more dire. So as we take a step back and look at the sequence of what got us to this point, it's important to recognize a couple catalysts. And a lot of those had to do emanating from China. We had the currency devaluation. We've seen incredible volatility, downside volatility in the Chinese stock market, and that's being used as a signal for the market to take a view that global growth is collapsing, financial markets are going to go into a free fall. We think that is a significant overreaction. First, let's look at the currency adjustment. China made a very small, in the global scope of currency movements, adjustment, right around 5%. In the magnitude of what has been a long appreciation in the currency, it is a fairly modest move to more accurately reflect some of the capital outflows that have been leaving China. There's also some small growth impulse that the exchange rate depreciation will give, but that is a very minor impulse. What is more important is to understand why they are moving to more of a flexible exchange rate. And this has to do with a multi-year plan to internationalize the yuan, make it one of the top 3 leading global currencies. And in order to do that, the currency needs to be free floating. And so this was a move in that direction. We don't think it's the beginning of a massive devaluation of the Chinese yuan. Then looking at the stock market, clearly there's been a lot of downside pressure there, a lot of policy confusion in how to manage that. But taking a step back, it's important to recognize, one, the Chinese stock market as a percent of wealth in China is a small fraction. It is almost insignificant as a percentage of people's individual wealth. It's also important to understand that what is going on in China is an uneven economic trajectory. On the one hand, you have parts of the economy that have been or are still in significant recession. The housing market's been in recession for a couple of years. It now looks like it's bottoming. Big parts in the manufacturing sector are in recession. Local governments are in recession. That is causing stresses on certain companies that are related to those sectors. And so to see downside volatility in their stock prices is not surprising. However, on the other side, changing labor dynamics, changing the wage structure, that is pushing upward pressure on wages, has given a huge support to consumption in China. The higher wages, improving consumption, is going to have a more meaningful impact on wealth levels than a decline in the stock market that is not represented in people's individual assets. Additionally, you've seen the growth of service sectors, and you've seen the rise of investments in infrastructure relating to transport and environment. These different currents, the recession in part of the economy, the expansion in the other, will likely balance out to about a 6 to 7% growth rate, nowhere near the dire predictions that many in the market are making of a complete implosion of Chinese growth. So we think there's a rebalancing. It's uneven. It's causing some ripple effects in certain financial markets. But in aggregate, we think the Chinese economy is on sound footing to grow between 6 and 7% this year and probably into next year. However, financial markets are not reacting to that scenario. They are predicting a far worse scenario. If we look around the U.S. Treasury market, the euro, the yen, we've seen massive appreciation of the euro, of the yen. We've seen U.S. Treasuries, 10-year yields just recently went back below 2%. We think these are completely inconsistent with underlying fundamentals of a U.S. economy that is on a steady growth trajectory, with the U.S. labor market improving. That is not consistent with where Treasuries have been moving. So we think there's huge value in continuing to short U.S. Treasuries, which we've maintained in our portfolios. Additionally, even though there's talk that the Fed may be moving out its rate hike cycle, there is no question that the Fed will be leading a monetary tightening relative to Japan or relative to Europe. And therefore, the euro and yen strength, we think, is very temporary and on very thin ice, and we continue to maintain short positions in those and position for a strong US dollar against those currencies. Lastly, the new opportunity that has come about over the last month is one of those once in a decade opportunities where you've seen places like the Mexican peso, the Malaysian ringgit, the Korean won, the Indonesian rupiah, Brazilian real, a number of key emerging market currencies have tested all-time lows. In Asia, many of the currencies are approaching or at the levels that we didn't see since the Asian financial crisis, when Asia was the source of the crisis. Today, fundamentals are very different than they were back in the late 90s that caused that crisis. In fact, most countries have significantly higher reserves, running large current account surpluses. Growth is on much stronger footing than it was back in that period where there was an investment bubble, huge macro imbalances that led to a collapse. We're seeing tremendous value in that region. The second would be in Latin America. The Mexican peso went above 17 pesos to the dollar. It's never traded there before. It's had a bigger depreciation than we've seen during the tequila crisis in the mid-1990s, when the economy was living day to day on very short-term capital, and any disruption to that led to a complete implosion of their economy. Mexico today has very little debt, strong reserves, good leverage to the U.S. economic recovery. Again, a once in a decade, if not several decade opportunity that we're seeing in some of these currencies. So we understand that this last month has been volatile. There's some significant downward pressure on a lot of financial assets, but we think this is a tremendous opportunity because the panic is not rooted in underlying fundamentals. And we actually think while the global environment isn't perfect, it's nowhere near what the markets are pricing in. So we're taking this as an opportunity.